Open your banking app for a second. Look at your savings account. There's probably a small number sitting next to it, maybe 4.5%, maybe 5%. Pull up your mortgage statement. There's another number, maybe 7.2%. Tap into your credit card. There's a third number, often something like 22%, sometimes higher. If you've ever stared at all three of those numbers and thought, wait, why is my savings paying 4.5% while my mortgage costs 7% and my credit card charges 22%? Where do these numbers actually come from? Then you've already taken one foot into the door of macroeconomics. Because here's the thing. Interest rates are not numbers that banks just make up. They're the downstream end of an enormous current flowing through the entire economy. And at the very top of that current sits a single institution, the Federal Reserve, the mother of every interest rate you'll ever see. Today we're going to follow that current from the top down. From the Fed, through the market, all the way to one of the most important concepts in all of finance. The discount rate, the single hidden variable that secretly moves the price of every asset on the planet. What is interest? Before we get into the mechanics, there's a fundamental definition I want to nail down first. What is interest really? At the most abstract level, the answer is this. Interest is the price of time. That probably sounds strange, so let me show you what it means. Imagine I give you two choices. Choice 1. I hand you $1,000 right now today. Choice 2. I promise to hand you $1,000 exactly 1 year from today. Which do you take? Almost everyone takes choice 1, the $1,000 today. And it isn't because humans are impatient. It's because the $1,000 in your hand right now can do something. You can invest it, spend it, pay down debt with it. The $1,000 a year from now can do nothing for you in the present. So the waiting itself, the year of having nothing, has value attached to it. Now imagine I sweeten the second offer. I say, lend me $1,000 today, and I'll pay you back $1,050 a year from now. That extra $50? That is the price of waiting. That is interest. Or, as John Maynard Keynes put it almost a century ago, interest is the reward for parting with liquidity, for giving up the freedom to use your money right now. Once you see it this way, you realize interest can never be just a number. Some institution picks out of the air. It's a price, a market price. It reflects how an entire society values the difference between now and later. In societies where waiting is valued highly, interest rates are high. In societies where waiting feels cheap, interest rates are low. That's not a metaphor. That's literally what's happening. From the Fed to your wallet. All right. So where do all those interest rates you see in everyday life actually come from? The starting point is a single number called the federal funds rate, the policy rate, the benchmark rate, different names for the same thing. This is the rate the Federal Reserve sets directly. 8 times a year, the Federal Open Market Committee, the FOMC, meets and decides on this one number. As of recent meetings, the federal funds rate has been sitting in the mid-4% range. Now, here's the thing most people don't realize. This rate is not directly the rate on your mortgage, or your savings account, or your credit card. The federal funds rate is, technically, the rate at which commercial banks lend to each other overnight. From there, it cascades through the rest of the system. Once the Fed sets the policy rate, the interbank market sets its own rates, things like the Secured Overnight Financing Rate, often called SOFR. Then commercial banks layer on their own margin and risk premiums to come up with the rates they offer you. For savings deposits, for auto loans, for mortgages, for everything. Think of it like a reservoir. The federal funds rate is the water at the top of the mountain. From the reservoir, water flows down into rivers. The rivers split into streams. The streams branch into the small pipes that finally reach your kitchen tap. When the reservoir fills up, that is, when the Fed raises rates, every river, every stream, every faucet downstream eventually starts running with more water. When the reservoir drains, when the Fed cuts rates, everything downstream eventually slows down. So when you see a headline that says, Fed hikes rates by 25 basis points, what you're really seeing is the moment someone opened the dam a little higher at the top of the mountain. The water hasn't reached your kitchen yet, but it's coming. One important nuance. The speed at which it reaches you depends on the product. Savings account rates respond fairly quickly. Banks compete for deposits, so they adjust within weeks. Adjustable rate mortgages adjust on their reset schedule. Could be 6 months, could be a year. Existing fixed-rate mortgages don't adjust at all, of course. They're locked in. But new mortgages will reflect the new rate environment within days. Credit card rates? They follow on their own timeline, usually tied to the prime rate, which itself follows the federal funds rate. This transmission lag, the gap between a Fed decision and when it actually shows up in your wallet, is one of the most important topics in macroeconomic analysis. It's why monetary policy feels slow. It's also why central bankers have to act in advance before the problem they're trying to fix has even fully arrived. Not one rate, but a spectrum. Here's something I want to make explicit. When we say the interest rate, we're being sloppy. There is no such thing as the interest rate. What exists in the real world is a spectrum, a whole landscape of interest rates, all coexisting at the same moment. Look at it this way. At any single point in time, in the same economy, under the same Fed policy, a high-yield savings account might pay 4.5%. A 2-year Treasury note might yield around 4.6%. A 10-year Treasury note might yield 4.4%. An investment-grade corporate bond might offer 5.5%. A high-yield or junk corporate bond might offer 8%. A credit card cash advance, 25%, sometimes more. All of these exist simultaneously. So what determines where any given rate falls on the spectrum? Two main variables, maturity and credit quality. Let's start with maturity. The general rule is this. The longer you lend your money out, the higher the rate you should demand. Lending money for 10 years should pay more than lending for 1 year. The reason is simple. A lot more can go wrong over 10 years than over 1. Inflation could spike, a recession could hit, the borrower could go bankrupt, the currency could lose value. All of that uncertainty has to be compensated for. And the longer the time horizon, the bigger that compensation has to be. When you plot interest rates against maturity, overnight, 1 year, 5 years, 10 years, 30 years, you get a curve. That curve is called the yield curve. And the yield curve is one of the most important tools in all of macroeconomics. We'll dedicate an entire episode to it later in the series. Episode 24. For now, just hold on to the basic intuition. Longer maturity, higher rate, usually. Then there's credit quality. Same principle. The higher the risk that the borrower won't pay you back, the higher the interest rate you should demand. Lending to the U.S. government, that is, buying a treasury bond, is considered the safest loan you can make in the world. So, treasuries pay the lowest rates. Lending to a top-rated corporation like Microsoft or Johnson & Johnson pays a bit more. Lending to a riskier company, a junk-rated issuer, pays significantly more. Lending to an individual through an unsecured credit card pays the most. So interest rates are never one number. They're a vast grid, maturity on one axis, credit quality on the other, and on that grid, thousands of different rates exist all at once. That grid is the market. The discount rate, why rates move everything. All right, now we get to the most important part of this entire episode. The reason interest rates matter so much isn't because they affect your mortgage or your savings account. That part is real, but it's downstream. The real reason, the one that makes the Fed's rate decision the single most watched economic event in the world, is this. Interest rates determine the price of every asset on the planet. To see why, you need one concept, the discount rate. Here's the logic. The value of any asset comes from the future cash flows that asset will produce. A stock is worth something because the company behind it will presumably generate profits in the future. A bond is worth something because it will pay you coupons and return your principal. A piece of real estate is worth something because it will generate rent and eventually a sale price. A business is worth something because it will throw off cash for its owners over the years to come. But, and this is the key, remember what we established at the beginning of this episode? $1,000 a year from now is worth less than $1,000 today. So when we value an asset, we can't just add up its future cash flows. We have to discount each future dollar back into today's dollars. We have to convert tomorrow's money into now money. And the rate we use to do that conversion is the discount rate. Here's the critical part. The discount rate is ultimately derived from interest rates. When interest rates rise, the discount rate rises. And when the discount rate rises, the present value of the same future cash flows gets smaller. Same future profits, same future rents, same future coupons. But the present value of all of them goes down because the discount rate went up. Which means this: when interest rates rise, stocks, bonds, real estate, every cash-flowing asset on the planet faces simultaneous downward pressure on its price. 2022 was the most violent demonstration of this principle in recent memory. The Fed, fighting inflation, hiked rates from essentially 0 to over 5% in about 18 months, the fastest tightening cycle since the Volcker era. And what happened? U.S. stocks fell. U.S. bonds fell. Bonds, which are supposed to be the safe haven, had their worst year on record. Real estate prices froze and then declined. Crypto collapsed by 70%. Everything, all at once. The old conventional wisdom, when stocks go down, bonds go up, broke in 2022. Because the very thing holding all of those asset prices up, the low discount rate, was being yanked out from under the entire market. That is the real reason interest rates are the single most watched variable in finance. Not because they change your mortgage payment, they do that too. But the deeper reason is that they sit underneath the price of everything you own. Stocks, bonds, houses, crypto, private equity, venture capital, all of it. Hanging from one invisible thread called the discount rate, and that thread is woven from interest rates. This is why, when the Fed chair speaks for 30 seconds at a press conference, hundreds of billions of dollars in market value can move within a single minute. He's not just talking about borrowing costs, he's talking about the foundation underneath every asset on Earth. R-star, the invisible rate. I told you earlier that interest is the price of time, which raises a strange question that economists and policymakers have wrestled with for over a century. What is the right price of time? The Fed currently has its policy rate in the mid 4% range. Is that the right level? Too high? Too low? Compared to what? The answer to that question lives in a concept called the natural rate of interest, often written in the academic literature as EUR*, with an asterisk after the R. The natural rate of interest was first proposed by a Swedish economist named Knut Wicksell back in 1898. His definition, in modern language, is roughly this: the natural rate is the real interest rate that would prevail when the economy is growing at its full potential and inflation is stable. In other words, ER* is the interest rate that is neither stimulating the economy nor restraining it. The neutral rate, the level at which monetary policy is doing neither too much nor too little. Here's the problem. R* is not observable. It's not a price tag floating around anywhere in the market. It's a hidden variable that has to be estimated using economic models. The most widely cited estimate comes from the New York Fed in what's called the Laubach-Williams model, first published in 2003, continuously updated since. According to that model, the U.S. natural rate of interest was around 3% in the early 2000s. After the 2008 financial crisis, it fell to below 1% and stayed there for almost a decade. Recently, in the 2020s, most estimates have it recovering to somewhere between 1% and 1.5% in real terms, which, after adding a couple of percent for the inflation target, implies a nominal neutral rate of around 2.5 to 3%. That number matters enormously, because it tells the Fed where they should be aiming. Here's the interesting part. The market reacts violently to changes in the estimated R*. When the Fed chair drops a single line in a press conference suggesting R* may be drifting higher, the entire bond market reprices. Long-term Treasury yields can move significantly within minutes. Why? Because if R* is higher than previously thought, it means the whole future path of interest rates is higher than markets were pricing in. And remember what we just established. When rates go up, every asset reprices down. This story isn't just an American one. R* has been falling across the developed world for decades. In Japan, the natural rate has been estimated to be near zero, or even slightly negative, for years, which is a big part of why the Bank of Japan kept rates near zero for so long. In the Eurozone, estimates have also been very low, hovering around zero in real terms. The underlying drivers are global: aging populations, slower productivity growth, a glut of savings looking for safe places to sit. So the takeaway is this: Behind every visible interest rate you can read off your bank statement, there is an invisible rate operating in the background, quietly governing what counts as tight and what counts as loose monetary policy. That invisible rate is R-star, and it's one of the variables that serious macro analysts and central banks watch more carefully than almost anything else. Next time you hear the Fed chair mention R-star at a press conference, you'll know exactly what they mean, and you'll know why the market just moved. What we covered. So today, we walked through what interest rates really are. Not just numbers on a bank statement, but a layered system that starts at the Fed and flows out into every corner of the financial world. We saw that interest is the price of time, that the Fed sets the source of the current, and the rest of the system flows downstream from there. That interest rates aren't one number, but a spectrum, shaped by maturity and credit risk. And, most importantly, that interest rates are the single most important variable in pricing every asset on the planet, because they determine the discount rate that converts future cash into present value. A single sentence captures all of this. Written almost 90 years ago in The General Theory of Employment, Interest, and Money, John Maynard Keynes wrote, "The rate of interest is the reward for parting with liquidity." Think about that. Every number we covered today, the 4.5% on your savings, the 7.2% on your mortgage, the 22% on your credit card, even the invisible R-star. Every single one of those numbers is just a price on the act of giving up the freedom to use your money right now. The market negotiating, every single day, the value of waiting. Which raises the next question. Today, we looked at how interest rates work inside a single country. But what happens when interest rates cross borders? If the U.S. Federal Reserve has its policy rate at 4.5%, and the European Central Bank has theirs at 2.5%, and the Bank of Japan has theirs near zero, what does that gap actually mean? How does money flow between countries when the price of waiting is different in each of them? And how does the value of one currency get set against another? That's the topic of the next episode. Exchange rates, how one currency becomes another. The number you see every time you book an international flight or order something from abroad, the number that quietly redistributes wealth across the globe. We'll unpack what it actually is and where it comes from. I'll see you in the next one. Wall Street Wires Foundations. If this helped clarify what's been hidden inside that one little percentage on your bank statement, hit subscribe and turn on notifications so you don't miss the next episode.